Hey everyone, welcome back to Corporate Decoder, the place where we try to understand what companies are truly up to behind all those fancy words and numbers. Get ready because today we're diving into MEDI Group Limited's latest filing, and let me tell you, there are some eyebrow-raising moments in here about their financial health and future. Before we jump in, if you love getting the real deal behind these corporate documents, make sure you are subscribed. For more in-depth discussions and to connect with fellow corporate sleuths, join our awesome Discord community linked in the description below. Alright, let's get straight to it. This is a post-effective amendment to a registration statement from MEDI Group Limited. Essentially, they are updating some information for their public offering. They need to raise money and are planning to list on the Nasdaq Capital Market under the ticker MEDI. They are looking to raise about $15 million by selling roughly 3.3 million Class A ordinary shares. The estimated price per S-share is between $4 and $5. Now here is something important to note. MEDI is a holding company. All their actual business happens in Hong Kong through subsidiaries. So when you buy MEDI shares, you are buying into the holding company, not directly into the businesses on the ground. This structure comes with its own unique set of risks. They have a dual class share structure. Class A shares get 1 vote each, while Class B shares get a whopping 20 votes each. This means the guys with Class B shares have way more control, even if they own fewer shares. This is often done to keep control within the founding team or early investors. This is a big red flag. Their own auditors are saying there is serious doubt about whether the company can keep operating. This is usually because of negative cash flow, persistent losses, or not enough cash to cover debts. The company mentions weak economic conditions in Hong Kong, competition from mainland China, and emigration of middle-income families, shrinking their customer base as reasons. They do plan to raise money from this, offering bank borrowings and shareholder loans to hopefully stay afloat for at least another year, but there is no guarantee they can get that money. Let's look at the numbers themselves. For the year ending the 30th of June 2025, revenue was about $5.2 million, down from $6.1 million the previous year. That is a 14.6% drop, losing nearly $1 in $5 of revenue. Net income also dipped slightly by 1.3% to around $600,000. While they are profitable, the trend isn't great, and with negative cash flow from operations, this adds to the going concern worries. They operate in Hong Kong dollars but report in US dollars. So currency fluctuations can play a role in their financials, but they state the exchange rate between Hong Kong dollars and US dollars has been pretty stable. The impact of COVID-19 is explicitly mentioned as a major disruptor. They had to close down service centers and are still feeling the effects. They are trying to get back to pre-pandemic levels, but it is an uphill battle. Looking at their assets, they have property and equipment, but also significant right-of-use assets. These come from leasing their office and shop spaces. Their lease expenses are quite substantial. A big chunk of their liabilities is something called contract liabilities, which totals over $5 million. This represents money received from customers for services not yet rendered. The fact that this is so high suggests a lot of customer prepayments, which is good for cash flow upfront, but means they still have a big obligation to deliver those services. Interestingly, their expired treatments revenue is a huge part of their total revenue, something like 58% for the year. This means a lot of customers are not using up their prepaid services. While this contributes to revenue, it might also signal issues with customer retention or forced sales that aren't being fully utilized. Their selling and marketing expenses decreased significantly by 24.4%, mainly due to fewer staff and lower lease expenses. General and administrative expenses also saw a slight increase driven by preparation for this offering. Let's talk about leadership. Angie Honkin is the chairman CEO and a key executive. He holds a significant portion of Class B shares, giving him a lot of voting power. The company also has independent directors, which is good for governance. There are significant risks tied to doing business in China and Hong Kong, including potential government oversight, regulatory changes, and even the possibility of their organizational structure being disallowed. They are also aware of the HFCWA, or Holding Foreign Companies Accountable Act, which could lead to delisting if auditors aren't inspected. This is a major concern for many companies with Chinese operations listed in the US. They warn investors directly that this is a high-risk investment. They expect to retain all earnings to grow the business, so don't expect dividends anytime soon. The dilution from this offering is also quite high, with new investors potentially facing immediate dilution of over $4 per S-share based on their estimated offering price. Their independent auditors Tadad LLP have pointed out that substantial doubt exists about the company's ability to continue as a going concern. This is because of negative cash flows from operations and significant working capital deficits. They do have plans to get more funding, but there is no guarantee they will succeed. So what is the story here? Well, MEDI Group Limited is trying to go public to raise much needed capital. They have a business in Hong Kong offering beauty services, but they are facing serious financial headwinds. Revenue is down, costs are high, and their own auditors are worried about their survival as a going concern. The dual-class share structure gives a lot of power to a few individuals, and there are significant regulatory risks tied to their operations and listing. Right now, it looks like a very speculative investment, and investors should be extremely cautious. Alright, that is our deep dive into MEDI Group Limited's filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.